Welcome everybody. Thanks for spending your time here today. I'm Walter Peters, as you know, and what we like to do at these webinars is we like to look at naked forex trading systems. Those are trading systems without indicators. Now, what you will notice when you use indicators is that they'll often go through phases of working and not working. So I've got the Euro-Yen chart on here, but really I could have any chart on here. And what tends to happen is that most indicators will basically work really, really well in those situations where the market's trending, or they work really, really well when the market's not trending and sort of directionless. So for example, if I had, let me show you here, let's say I used I don't know, it doesn't really matter, but let's say I use a MACD, okay. Let's say I use a MACD, and every time the market went down below, and this red line crossed below, so if I did this, let's say I was going to do this, whoops, and I say, okay, if the market crosses below, if this red line crosses below on the MACD, I'm going to sell. So in other words, I'd sell right here, oops, right around here I'd be selling, and you can see that the market actually went up there. It did go down a little bit, and then it just rocketed back up. And then I'd say, okay, well, it crosses above, I'll go long, like right here. So I'll buy here, and it goes up a little bit. But you can see what's happening here is the market's kind of just going up, and then it's going down, and then it's going up, and then it's going down. Which basically means when it crosses down here, so I'd sell right here, and then the market just rockets up, so I'd get stopped out in that case. So in this little area here, the market doesn't really do what we'd expect it to do. Can everyone hear me okay? Hi. Yes? Okay. Great. All right. Okay. So someone said he couldn't hear, and I just I was not sure if everyone could hear. Okay, so the sound is all right. All right. So in these cases where the market's chopping around, it's a little bit difficult for an indicator like the MACD to really make sense. Now, in other cases when the market's really taking off in a trend, you can see it works quite well. Like over here, see how the MACD, it crossed above the zero line here, and then the market just rocketed off, and it just went and went. In these cases, it's great, right? But that's not always the case. In fact, most of the time you'll notice the market kind of does what it did right here. It goes up and then it goes down. It goes up and then it goes down. Rarely does it really just take off. And so in those situations when the market really takes off, will an indicator like a moving average or a MACD usually work. It usually doesn't work except in those cases. Now, in other instances, let's go to another one here. We might go with like a stochastic. And if we're using a stochastic, as many of you know, normally what will happen is people say, okay, when the stochastic turns lower, we sell. So right here, with the stochastic, we'd sell right here. The stochastic's above 80, and then it comes down, and we sell, right? Well, obviously the market went up. So we lost out here, because it's the beginning of a trending market. Now, obviously, we would have been okay down here when we bought, or may have been okay down here when we bought when the stochastic dipped below 20, and then we bought here. We may have been okay. I'm not sure. It went up a little bit, but then it came back down and may have stopped us out actually right here. Let's see. It depends on where your stop is on that one. And then up here we see it goes above 80, and then it briefly went down here, so you may have sold here. That would have been a loser. And then right here you may have sold right here, and that probably would have been a loser too. Maybe a small profit. But the point is that the stochastic indicator works really well when the market's sort of just chopping around, like over here. So it goes over bought, and then it comes back down, and we sell right here. So that would have been okay, because it did get a little bit of a move down. And then right here we have another sell right here, and that actually went down quite a bit. So in the directionless markets, an indicator such as a stochastic, or sometimes indicators like momentum, things like that, those can work quite well in sort of directionless markets. And in trending markets, moving averages and moving average based indicators like the MACD can work quite well. But that's not what we're here to talk about. What I want to talk about is how we can use no indicators and get a pretty good idea of what the market's going to do. And when we figure out what's happening, we work off of a no indicator based system. And how we can use no indicators to find those situations where the market's broken out of its sort of sleepy time and is getting ready to go. Now, on a lot of the yen pairs, we're actually in that situation right now. We're in a situation where the market is stuck, and it's probably going to have to get out of this stuck area. And once it does, we're going to be in a great situation to jump on a trade. And I'm going to be really excited about these yen pairs. And I can talk more about why I'm so bearish these yen pairs, but for the moment, you can see what I've done here. I've basically captured the recent price action movement on the 1-hour euro-yen chart with these two trend lines. Now, I can use trend lines, or I can use horizontal support and resistance. If I were using horizontal level, I probably would draw something right here around 121.11, and then down here at the bottom around 119.16. Either way, it can work, but I think at the moment it looks like these trend lines actually capture the market slightly better than the horizontal levels, and that's just because it seems to be penned in here by these trend lines. The same principles work whether I'm using angled lines such as trend lines or if I'm using horizontal support and resistance. Now, I'm going to be honest, I prefer horizontal support and resistance under most instances, and the reason why is because those horizontal levels tend to have more agreement. In other words, a lot of traders can see those, especially the recent one. I'll show you an example. Right here, this is something that I actually sent out to my trading buddies yesterday on the Aussie Kiwi. And this is the Aussie Kiwi daily chart. And what we see here is where there were lows over here at 124 even. And yesterday the market started inching up, and it actually hit that 124 level, and it's pulled back since then. And if you look at the line at the if you look at the 1-hour chart, you'll see that we did get a little bit of a kangaroo tail action here. And if you don't have the kangaroo tail book, I'm sure most of you have it. You can email me and I'll give it to you. It's free for you because we like you. Walter@fxjake.com, and I will send you the kangaroo tail book. Just email me and ask for the kangaroo tail book. But basically, this one didn't trigger because the market didn't trade lower than the kangaroo tail. Technically, it probably wasn't one because the close was just a little bit too high. It was a nice long tail. And then we got this one. And this one also did not trigger because it moved up and didn't make a new low until 2 hours later. But if we look at the 4-hour chart, what we see here is something different. On the 4-hour chart, you actually have a nice kangaroo tail with very little space. However, remember, we know that the market's looking at this area, this 24 area, 1.24, because it's bounced off of it in the past. In fact, it bounced off of it right here. Boom and boom. This is back in October of last year. So the market remembered this level, and it just hit it recently. And this is really why I like horizontal support and resistance levels, because they become very easy to see for traders. Everyone can see that the market hit here and then fell. Everyone can see that the market's just recently hit here. So for me, these horizontal levels are really ideal. I prefer using those to trend lines. But in this case, at the moment, the trend lines actually fit quite well. So we know that we're in a range-bound situation. We know that we can construct boundaries of this range-bound situation with this horizontal level at 119.16 or this horizontal level at 121.11. But what do we do when the market's in that level? What do we do when it's constricted like this? And how do we know when the market's ready to get out? Well, the easiest way, the simplest way, the best way I know of to make sure that I don't get sucked into some fake out is to simply wait for the market to get out of my boundaries, whatever they may be, whether it's a trend line like here or a horizontal level like these. And then once it breaks out of those boundaries, I wait for the market to come back and touch it or kiss it and then move away. This is what's known as, and all of the rules, they're all known as the last kiss. And if you have the book that I wrote called Naked Forex, you know about the last kiss. There's a whole chapter, lots of charts, lots of examples on the last kiss. But what I want to expand on the last kiss tonight is the fact that we can use it outside of just horizontal support and resistance. We can use last kiss on trend lines. And in fact, if you look at what's happened in the markets, you'll notice that this sort of thing happens all the time. Does anyone have a chart you would like to look at? I don't want to cherry pick examples. I actually want to take your chart and show you exactly what I'm talking about so that you can see it for yourself. I don't want to just, take... we'll get back to the euro-yen and the yen pairs because they're primed up right now. But I want to look at any chart that you would like to look at so that we can see these principles and how they work and how you can spot them. Raul. Hi, Raul. EuroCAD. Okay, EuroCAD. Who said EuroCAD? Raul said EuroCAD. Okay, let's do EuroCAD. Where the heck is it? Here it is. Actually, well, we could use much. Okay, well, this is pretty good, actually. EuroCAD is actually a great candidate because it's in that situation right now. Let's okay. Let's actually. It's easier for me to do a clean chart actually because I don't want you to be distracted by what's happening on the chart. So I'm going to go with my black and white template and my 4-hour EuroCAD. Okay, so let's scroll back and let's see if we can find what I'm talking about. And does it occur, does it happen on the EuroCAD chart? What I'm looking for is an area of consolidation or an obvious sort of trend line. Either one works, really. Here's an obvious one. Here, I think. Maybe that one's not so good. Let's find another one. This is actually a pretty nice one right here. Okay. I know a lot of you do know about the last kiss, but what will be good about tonight or today, depending on where you are, is that you can see it happen on trend lines, and it's a different way to use it. It's a different way to expand these trades. The thing that's great about the EuroCAD is it really likes to take off and run. That's what I like about it. Okay. Okay, here's a good one right here. Let's first do the typical last kiss, which it looks something like this. This is probably as good an example as we're going to find on this pair. Now, I wanted a really nice consolidation area. Can everyone see that we've got consolidation here? The markets between July 11th and August 3rd was really stuck in this range. And this range on the EuroCAD 4-hour chart was about 253 pips, which is not a lot for this pair. And so we're stuck in that range, right? Now, what's nice about so I've drawn a box here, and this box has the top area here. The highs are contained here. Now, what's nice about this box is that the local area of support lines up with the top of the box, which is great. See, I've got 3 bounces here. 1, 2, 3. Then the bottom area of the box lines up with all of these touches here. There's one there, and then 2 or 3 actually, maybe even 4 right there. Now what you will often notice is that the middle of these boxes, when you draw them, they often have I'm just changing the color here, guys. There, you should still see my chart. That might have looked a little bit weird. I think the software was not ready for me to do that. But basically what we have here is the middle of the box. Now, it's not technically the exact 50% mark. In fact, there are 130 pips between the top to the middle, and then from the bottom to the middle is, well, almost, it's pretty close to the middle in this instance, but that's not always the case. Sometimes it'll be a little bit higher, a little bit lower. The reason why this is critical is because if I'm trading off the edge of the box here, and I know after it's bounced a few times down here that it might go up, especially after I see this long tail here, I have to be wary of the fact that it might just get stuck at the middle of the box. And so at this stage, at this stage right here, I would know that the market has a middle of the box right here because I see a bounce there and I see two tops right up there, and I can see that on the candles. So if I bought off the edge of the box off this long tail here, I would have been ready to take profit here, or at least remove my risk, because it may not get to the other side of the box here. Now in this case it did, and then it fell, and guess where it reversed? Right there in the middle of the box. It's why it's critical to have a middle of the box. Now a typical, like a normal sort of breakout trader might say, in this case, okay, it's out of the box, I'm going to go long somewhere in one of these 3 candles. Likewise, a typical breakout trader might have sold down here somewhere because the market started inching its way out of the box, or even down here where our long tail printed. Those are what I call fake outs, because it looks like it's going to break out of the box, but it doesn't. And it comes back in the box. So the reason why I don't trade those is because I don't want to get sucked into a fake out. Does it mean that I will occasionally miss really good trades because I don't get in as soon as the market, exits the box? Yes, that happens. That's part of the deal. However, I am like most traders, I prefer a higher win rate. And a higher win rate comes if I wait for the market to come back and kiss the edge of the box, like so, like right here. Notice how the market broke out of the box on this candle and closed outside of my line in the sand, which in this case is 1.3706. Notice also that it spent 1, 2, 3, 4, 5, 6 candles outside of the box before it finally dipped back down and touched it and kissed it with this tail right here. Now some of you may be saying, well, the low of that candle is 37.17 and the high of your box is 37.06. Yeah, it missed it by 11 pips, but on a 4-hour chart, especially with this pair, that's not a problem whatsoever for me, and that's completely reasonable to go ahead and say, that's a kiss on the edge of the box. So what do I want to see after the market spends at least a few candles out of the box and then comes back down and kisses the box? Well, what I want to see is the next candle should trade higher than that kiss candle. And it did. See how the next candle here actually broke higher? That tells me that the market's likely to go higher and higher, and it does. Now, how do I know what my targets are? A really easy target is obviously you just say, okay, the box is 260 pips wide, so I'm going to go ahead and go for 260 pips. Now, it went over 300 pips, and that's great. but I could use some sort of a trailing exit. I could move my stop loss to break even once it moved X number of pips in my favor. Lots of things I could have done here. And most of them would have enabled me to capture a really nice chunk of pips here, because it basically went almost 400 pips. Just shy of 400 pips. So that is, in essence, the last kiss trade. What happens if I decided to trade, down here, I was looking at a MACD. Well, I might have gone long here, and then the market actually fell. I might have gone, well, actually, that was probably the best opportunity to go long. Maybe when it came back down here, around here, and then I decided to go long when it broke below the zero line, the histogram did. So maybe I went long on this fake out, and guess what? I get stopped out again. And then finally it comes down here, and then it starts going up again. Then maybe the MACD does sort of coordinate with my last kiss setup. But the basic idea here is that when the market's doing these chops and chopping around and respecting edges, especially these horizontal levels, we'll often see those oscillating type indicators work quite well, but the trending type indicators like the MACD will not. And that's why I like the last kiss, because the last kiss trade enables me to wait for a really nice touch. And now they're not always going to work out great, and what I'll do is my emergency stop loss is the middle of the box. Now that might seem like a lot, but in practice it's rarely hit. The reason why, so that's a risk of 259 pips in this case. But what will happen is if the market moves and closes back below my line in the sand here, and the candle actually closes below 37.06, I get out. So I don't wait for my stop loss to be hit. That's just sort of the world's crashing and the markets are crumbling and my stop loss was hit when I was sleeping. That's what that is. That's an emergency get out quick stop. But my normal exit for these would be if the market sags back down in the box, closes in the box, and then I say, okay, I'm out. That's the kind of thing that normally happens with these, if they end up being losers. But I think what you'll notice is that you'll often get a really good win rate with these. Test them for yourself, see them for yourself. But generally what happens is they're quite good. This one probably aren't enough touches here to qualify as a box there, so I'm going to delete that one. Now, how might we trade these? You can trade inside the box, Ahmed, but I like to wait for the breakouts. They're better. To me, those are better. Those are really the way to go. The breakouts, yeah. Now, what about those situations when you have a trend line and the market breaks the trend line? Well, what will sometimes happen is you get a nice retouch, last kiss style on these. Let me see if I can find one here. It looks like we have one right here. Here you go. So this is exactly what I'm talking about. It's the exact same principle, but you're using it on your trend line. So it's a little bit tricky because we don't know how everyone draws our trend lines. We don't know if you're like a Tom DeMark trend line guy, or if you're a Wicks or Bodies or whatever. Everyone draws them differently, and that's kind of one of the things I don't like about them. Whereas most of the people are going to see that somewhere around this level here, there's support, somewhere between 34.25 and 34.50. Somewhere in this range, people are going to say that's where the support is, right? Well, with trend lines, it's a totally different story. And I get emails from people telling me, you're drawing your trend lines wrong, which always give me a good chuckle. It's kind of like saying, you're drinking your coffee the wrong way or something like that. I don't know what a good analogy is, but that's pretty funny. So here's one right here. So we have this trend line. We've got a couple touches here. We got another one there. Okay, so now we've got our line. We got a near miss. Then we got a couple more touches here, and then it falls away, comes back up, closes right on our trend line, breaks out above it, starts riding it, and then it pushes away with this bullish candle. That's really the critical thing here, is this bullish candle, and it says it's going to move away from the trend line. Maybe you don't wait for this bullish candle. Maybe you actually are more conservative and you wait for this push away. Either way, you know that the market has now moved beyond the trend line. ideally, it would move actually away from the trend line and then come back down and bounce off of it. Let me see if I can find some examples of that sort of bounce action. Let's see. I think our Aussie CAD, did it do that? Yeah, kind of like this right here. Kind of like something like this. See how this trend line captured these two touches? The market falls, breaks through, then comes back up and touches it. You get these all the time. So if you're a last kiss type trader, you know, that's really and the trigger, of course, is the bearish candle. And so the stop loss goes above the trend line, basically above the bearish candle, and the next candle should really make a new low, and it did. It pushed through the new low, and that's a great setup right there. Obviously, we don't know if it's going to break through here. It closed on it, and then eventually did actually break through. But that's the kind of trend line setup where you get a breakout with a retouch, and you'll see them happen all the time. To me, where the market goes away from it, comes back up and touches it. A lot like the last kiss, basically. A lot like the last kiss. And if you don't get that retouch, you just miss out on the trade, basically. And that will happen occasionally. So let's talk about our... Yeah, so Aristide says that 3 precise touches with distance between them seem to define a solid trend line. Yeah, I've heard that, and I get it. The thing though is that, and if there are any breakout traders know that often what happens is, you know, the more touches you get, in most cases, the more likely it's to break out. So I kind of like two spots, because what will often happen is on that third one, it could actually break out. So you could wait for the third touch, and then you say, okay, now it's got to make a fourth touch. But what I've noticed is that sometimes you don't get that fourth touch. If you get 3 touches, that's a long time bouncing off a trend line, and you might actually see the fourth one collapse for you, that sort of thing. So it is tricky, isn't it? I mean, everyone's got their own. I'm not saying anyone's right or wrong. I'm just saying, everyone's got their own way of doing it. So that's why I don't like them. But so how would we trade some of these yen pairs like our euro-yen? Well, what if the 1-hour euro-yen chart broke below our trend line, sagged down here, and then tomorrow came back up and touched it with a bearish candle right here? Well, that would be a great selling opportunity, right? I'm a little bit more interested in a sell trade. Okay, I'll admit, a lot more interested in a sell trade on these yen pairs than on a buy trade. And that's just because the daily charts are screaming out, sell me, sell me, sell me. But for now, talking in terms of breakout trading, the simplest way to look at this is just to simply wait for a breakout above or below the line, and then wait for the market to come back and kiss off of it. Are there any questions about what we've talked about here so far? Does that all make sense for you? I basically just want to show you that whereas most traders are, they're just waiting and waiting. Like a lot of traders are going to get in as soon as the market breaks out of these trend lines. Some traders might even have bought right there in that last touch that we just saw. We basically just saw that happen. Some traders actually bought there because they think it's going to, break out above these highs or break out above this trend line. And now they're in a hole right now because they're down. So that's a very, very common thing. And that's why you see these spikes all the time, these fake outs, because there are a lot of orders there. And that's why I love the last kiss system, because it allows me to avoid those really nasty breakouts. Could you have a look at the euro? Could you have a look at the euro consolidation zone, if possible, on the 1 hour or the 30-minute? Let's look at the euro on the 1 hour. I don't really like to go down to the 30-minute all that often. So on the euro 1 hour, we have a lot. This is very similar to what we've been talking about, and that's why this webinar is so timely. Because in essence, we have a beautiful box with touches here, there, and there, and touches there, and there. So we've got 1, 2, 3, 4 touches on the lows, 1, 2, 3, 5 touches on the high. So the question would be, for some traders, is this, is it a sell, is it a buy, is it what? To me, it's a wait. It's a wait and see. And if I get the market going to the upside and then bouncing off here, I could buy. Going to the downside and then bouncing off here and printing a bearish candle, I could sell. So either way, we're in a really nice, well-defined consolidation area, just like we've been talking about, and we could last kiss this sucker. In fact, we could last kiss a lot of charts right now because we had a really violent move on Monday, and since then we've been resting. We have been resting. Here is the pound yen. Pound yen also, what might happen here? Well, we have our good friend, the trend line here. And here, guess what? We have multiple touches down here. Now, depending on how you draw it, maybe you capture these, the candles here or whatever, and that's a fake out, whatever. The point is, most of the time when this pattern emerges, the breakout is to the downside. In other words, most of the time, the market is going to break out and trade lower on the horizontal side. What's happening here is the trend line is squeezing the market into a horizontal level, and the breakout is almost always to the side of the horizontal level. Almost always. Nearly always. So that's that one. Looks quite good, actually. DV says he wants to sell the U.S. dollar index. Cool. The accuracy is going to depend on your testing. See, Jano, I don't really purport that it's going to be X number. See, here's the problem. I draw a box here at the Euro-US dollar 1 hour chart. Somebody else might not see this box. The key here is for everybody to do this. That's the key. If you can test this, you will find what the accuracy is for you. I know traders that love the last kiss trade, and I know traders that say it doesn't work for me. And both of them are right? Most of the time what we're doing is we're trading our beliefs. So what we have to do is find a system that fits our beliefs. So if you believe the big money is made when the market takes off and rips off in a trend, then you need to create a system accordingly. If you believe all the money is made when you can find the turning point of the market, then you will be a reversal trader. You'll look for those. If you believe the money can be made by holding and waiting for weeks, then you trade the weekly or daily charts. If you believe a lot of money can be made only if you get in and out quickly, then you're going to be a scalper. You know what I mean? So everybody has a different view. And I'm not here to say that this is a 79.7% accuracy rate. But for most traders who love this system and test it and get comfortable with it and see it happen, they find that it wins much, much more often than it loses. But again, it depends. I mean, everyone's different. I'm amazed at, the emails I get from traders I work with, and some of them say they love this system and others say that system. So the idea here is to find out, get exposed to a lot of different things and find out what works for you. And I don't mean that to be a cop-out. I just mean to say that you really need to test it. And if you can test it and see that it works, then you're going to have confidence. So really that's the process that I see, is you find a system. If it resonates with you, you test it, and then you go in and trade it. I love the 4 hour and the daily. Aristides, for the last kiss, I love 4 hour and daily. They're my favorite. Consolidation on. Do you time the breakout from the box with daily news? No, Ahmed, I don't, but I can see where that would make sense. And that might be a way that you would make this your own. If this is a system that you like, you could add that to it. See, and that's what really, the successful traders I know, that's what they do. They learn things, and then they go, oh, but then I'll add this to it, and then it'll be better. That's the kind of thing they do. So they don't just follow verbatim and go, okay, I'd yes, this, that, and follow the rules. What they do is they go, that sounds good, but what if you added this where you waited for the kiss to coincide with news or whatever, that sort of thing. I've been using kangaroo tail, Sylvester. It's nice. Yeah, it is nice. I agree. I agree. Euro, US dollar, kangaroo tail. We're looking at the euro, right? That's the 1 hour. That's the daily. Was the 1 hour kangaroo tail the one you were looking at? Because we still have ways to go. We still got the rest of the hour, 22 minutes. So probably not quite ready yet. And these 1 hour candles will change a lot in the last 5 minutes. They will just hop all around. Is there a consolidation on the 1 hour pound Kiwi? Let's look. Let's actually go to my 1 hour charts. That'll be better. Pound Kiwi. Pound Kiwi. Pound Kiwi. Well, there could be a consolidation. It doesn't look like it's quite there yet. Maybe we do something like this. See, this is what I might do. I might draw something like this in, and I might call this like a fake out right here. So I might wait for it to rock around here for a little bit. We've got 2 touches up at the top, 1, 2. We've got 1, 2, 3. 2 touches and a fake out at the bottom, and the line chart will show this. 1, 2, fake out. And then we've actually got 1, 2, almost like 3 touches on the upside. But yeah, that could be a consolidation. I would say it's really early days. I think it's it might take more time for it to ripen. But yeah. Yeah. Ray, what point do you know the system is right for you? Well, that's a good question, Ray. Basically, I can, if you email me, Walter at FXJake, I can tell you, I can help you out more there. But basically, the idea here is that you want to find a system that when you see it, you go, immediately you think that's going to make money. That's how you know that it fits your beliefs. If you see a system where you go, that definitely makes money, I think that makes money, I think that's a good system, if you're thinking those things, that's going to fit your beliefs. That's only part of the equation. Then you have to go back and test it, and you can use programs to do that. You can use MetaTrader, and you can just hit the F12 key and go boom, 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 and keep rolling along here. If I change this so that you can see like this, and I just wait here and I hit the F key and I advance 1 candle at a time and I write everything down in the spreadsheet. It can be as simple as that, so that I get a couple hundred trades under my belt before I start feeling really confident about my system. That sort of thing. I don't know if you noticed, but we actually had one right here. Just as I was blowing through here, we had this. Probably something like this. We've got our defined bottom of the box. It did break out briefly and then jump back in. We had the top of the box up here. Maybe the top of the box actually would be something like this. And then it broke out here, came back up, touched it with this candle, created a bearish candle right here, and so there goes the last kiss. See right there. And notice how the market never came back to close inside the box, so it just fell. So, and again, remember I was talking about the middle of the box? Well, that clearly is defined right here. See how the line chart shows you? The middle of the box is right, boom, 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 right there. And that is very, very common with these boxes, that somewhere in the middle you see that level of support and resistance. So this is another example of a last kiss on the pound New Zealand. Now, what about down here? You might have another one right here, and you say, look, I've got one right here. Maybe I've got one like that. It breaks out. It breaks out here, spends some time out of the box, comes back down, touches it with my bullish candle here, but guess what? It never trades higher than the bullish candle. Does everyone see that? See how it never, this candle right here, I'm going to zoom in so you can see. See how the market, this next candle never traded higher than the high here. The high here, 88.65. The high here, 88.63. So it did not take out the high, and then it fell back in the box anyway. It probably would have hit the stop. If you did go long prematurely here, you would actually been hit. Stop would have been hit right here because that definitely came back down in the middle of the box. Here it broke out, but it never really, it never really printed a nice bullish candle. The nicest one, this was actually probably a close back in the box here, depending on where the edge of the box is. Maybe not. Maybe you get a bullish candle here, right? So you say, I'm going to go long, and the next candle does take it out. But guess what? Maybe, depends on the edge of the box. Maybe, depends on the edge of the box. If your edge was a little bit lower, you would say that these candles did not close inside the box, in which case you would have been able to capture this move. Otherwise, probably on this candle, you say, it closed in the box, and you're out for a very slight loss. Maybe you took some profit right here, too, because after all, it did go up. It did go up, 35 pips on the pound New Zealand, and the box height, the box was 65 pips, so it did go almost, it went about half the distance of the box before it came back down. So that's essentially the last kiss setup. When you look would you look to take a trade on the Euro Pound daily belt break to the downside? Yes. I sent out an email about that, Rasika. I sent out an email about that. I don't know if you're on any of the lists, but like the personal trading program or the daily trader, but I sent out that's all part of the game. That's all out there. So let's take a look. It's probably not the best. We weren't really talking about belts, but there are so many belts in the markets right now. So here is a Euro Pound daily belt. Again, the daily belt idea is in my book, The Naked Forex, the book. But basically, we've got a lot of yen pairs giving us the same thing, and in essence, what we have here is a daily belt, and those are just brilliant. We did already trade lower yesterday, but a retrace entry makes sense here, and targets at 84.80 and 83.80 look good to me. So, to answer your question, Rasika, that's in a nutshell. That's sort of what I'm thinking. Yeah. Can you connect the box with the supply and demand concepts? Well, it's actually just to sort of follow up here. I understand what you're saying. This is the facts. The facts are this, though. What you will normally hear people say is that the reason why the market keeps bouncing when it gets down to 119 is all the buyers are coming in, right? And that's true. Buyers are definitely coming in down here, and the sellers are coming in when it gets up to 121, right? And that's true. And then what people say is when the market breaks out of the box, because if it breaks lower, let's say tonight, all the sellers are jumping on, and they're making it go lower and lower. All the sellers are piling on and making it go lower. Or if it jumps up and they say, all the buyers are jumping in and making it go higher. Actually, that's not true. What's happening is a lot of people are getting stopped out, and that's making it go lower. All the buyers have their stops down here, and so that's what's making the breakout work. Is all the buyers are getting squeezed out. Same thing with if it breaks up to the upside, all the sellers are getting squeezed out, and so it's a cascade of stop losses that accelerates the breakout, and nothing really more than that. I hope that makes sense. Normally, what people say is that it's it's profit taking, or it's buyers are piling in or sellers. Actually, what's happening is normally what happens is the stops are getting hit, and that's what makes it really go. and that's from broker data. The brokers will tell you that. That's from market data. So sometimes the local news is wrong when they say, this Google stock went down on profit taking. Whatever. Yeah. Peter, mate. U.S. dollar Swiss, if we can see on daily and hourly chart, there has been a downtrend, is making a downward triangle, which is a downtrend. All the signs showing strong downtrend, but how do I know if the trend is about to change? Yeah, the news is usually wrong. Exactly, Deviant. Okay, let's talk about this one. So, let's go to the Swissy. So the Swissy obviously gave us, for those of you that follow Kangaroo Tails, Swissy gave us a Kangaroo Tail buy at 91.15, and the stop was down here at 90.19. That was quickly moved to break even up here when it hit 92.15 right here, and it's, boy, it's really close. It has come really close to hitting that target up here at 93.35, but it hasn't quite done it. Probably, some people probably did pull out the last couple days. But that is an example of a Kangaroo Tail right there. And so if you don't have the Kangaroo Tail book, you can email me if you don't know what I'm talking about. We're not really talking about that tonight. But let's talk about the Swissy. To me, if I'm looking at this from a daily chart, here's a belt right here too, actually. Rosika, did you see that? This is actually, whoops. To me, this is more of a consolidation zone, and we're basically saying, we could last kiss this sucker. If it broke out of this box, we could last kiss it. That's kind of what it looks like to me. Now, if I look at the 1 hour, because I think you were talking about the 1 hour as well, what do I see in the 1 hour chart is I see, let's see here, I don't really see much. I mean, I could see where some people may have drawn some sort of a trend line here maybe, and then it fell out, something like that maybe. I just see consolidation. That's what I see. I see, especially on the daily, a big giant box of consolidation between, say 91 and 93.30. That's what I see. And the middle is down here around 92.20. Dominic says the U.S. Swiss was definitely below that level, though. Aggressive move. Yeah. Well, Kangaroo Tails are hopefully always like that, where the tail goes through the tail penetrates the zone. That's the ideal setup for the Kangaroo Tail. We like to see that penetration. Kind of like we on big shadows. Here's a big shadow here on the. This is the New Zealand Singapore, Dom, and see how it did the same thing. We talked about this one when it formed. See how the big shadow sort of penetrated and made a higher high than the belt did over here. The belt right here, bearish belt printed and the market went lower, came back up and double topped with the bearish big shadow, and the market actually fell down here. Now, it did mess around for a couple days here and made a lot of people nervous, made me nervous, so some people didn't take this. But if you did, you hit target 1 and target 2. Stop was obviously up here. But the fact that it penetrated the zone is kind of what I'm getting at here. That happens all the time. Look at the candles that have jumped up here. The high on the belt on the yen was 94.55. And the high over here was 94.45. So it actually jumped up 10 pips higher and then printed this big bearish belt. So that's it's nice to see the market penetrate these historic support and resistance levels because it can often rebound quickly and snap back like it did there. We'll do the belts in another webinar, Boyke. We'll have to because we're just out of time, and if you look at all the yen pairs, almost all of them have belts, and it's in the book, in the Naked Forex book. But we can even do a webinar on that sometime, so you guys can see how it works. The Swissy reminds me of the pound Aussie on the 11th of January. Let's take a look, because I don't remember it. Does anyone here recall what the pound Aussie was like on the 11th of January? 11th of January. Not that long ago. Right. So it kind of went up there, and then it fell. Right. Closed below that level. Right. Gotcha. I see. I see what you're talking about. Yeah, it had this kangaroo tail, and it was below the zone here. Yeah. So you're basically saying it's already made its... I see what you're saying now, Dom. You're basically saying it's already moved out. It's already made its way outside of that. Yeah, I think it's still in there. Yeah, the thing about the pound Aussie, was it the pound Aussie we were looking at? Yeah. The thing about the pound Aussie, a lot of people were excited about this kangaroo tail, but I wasn't so excited because we had all this resistance right in the way. And in fact, it broke higher, and then boom, it just fell after that resistance. It couldn't get through, and it just fell and collapsed like a brick. So, yeah. Tricky. Yeah, I tend to wait for belts and real strong moves away, like kind of like the pound Aussie here, and like this belt over here, this big bearish belt here. I kind of like to see the market move away, so there's no price action to the immediate left. These are the points here. See how there's no price action to the left here? These are the points where the market tends to reverse from. And so if we look at the Swifty and we just back it up and take a real, really back it up and see where are we compared to recent price action. Well, we're actually, where we've been since August. In essence, we've been in the same area here since August. So it's not as exciting as it was when it printed this kangaroo tail down here. That was more exciting to me. And these moves away from price action are the ones that I get excited about. Hopefully that makes sense. We can do a whole webinar on just that concept as well. But the basic idea here is I'm waiting for the market to get away from itself, and then that's where I look for reversals. Also, it can get away from itself, and you can pile it on a breakout or a trend sort of trade as well. Yeah, Dom says you'll see belts on the Dom, you will see belts on yeah, it's easiest to see belts on a broker that closes at 5 p.m. New York time. Yep, that's right. Because you won't have those little tiny 2-hour Sunday candles. Yeah. Yeah, that's right. 1 hour what, Sylvester? Last chart. Sylvester wants to see 1 hour what? Euro, okay. Let's look at the euro for the last couple minutes here. Yeah, that's pretty good. Looks like a kangaroo tail to me. But we have 5 minutes to go. Indicators aren't my favorite thing, Pan. They're really not. Look, they can be great. They really can. But they also can get you stuck into changing your system every 6 months because, the MACD drives you crazy, so then you go to the stochastic, and then you go to some whiz-bang thing that you got to pay $300 a month for or whatever. To me, it's just so much easier to learn price action, learn these naked principles, and then you can never get away from it. As long as if I ever look at a chart, I will immediately see kangaroo tails. And if I ever look at a chart, I will see big shadows and last kisses and belts and whammies and moolahs and everything. I will not get away from that because I can't help but to see them. Whereas if I'm using the stochastic for a year and then I get sick of it after I go into a 2-month drawdown trading the stochastic because the market's trending, I can just go, you know what, stochastic stinks, and I can throw it away. And then I can move on to something else. But once you learn naked forex principles, you can look at any market, any chart, any time frame, and you're going to see simple trade setups over and over again. Even if you use indicators, if you learn price action, what's great about it is you can never get away from it. You will always notice it. I can never throw away my price action indicator because it's always on the chart. If that makes any sense. Yeah, you got it, Dom. I'm glad you liked it. You can trade them inside the boxes, but let's look at this trade. Let's say that the market closes like this. Let's say that it closes. What's my risk here? I got 48 pips of risk, right? I've got 48 pips of risk on the euro, and I'm really not expecting it to go any further than 28 pips. If it goes 30, that's a bonus. So I can take this trade, but if I'm going to take this trade, I'm going to have to pray that it's going to break out of this box. So that's the problem with these. I would much rather see this one print at the edge of the box and the tail extend beyond. That would be so much better. To me, it's still in the box, and it's only got about 30 pips to go. It's got about 50 pips of risk. A lot of traders not so comfortable on that one. That's not going to be a favorite for them. These kangaroo tails outside of recent price action are so much better. See how this kangaroo tail printed here, and compare that to this one, where it's got this price action to the immediate left. It's good and it's okay. It's like a C. It's a C. I give it a C. A, B, C, D, F, American scale. I would say it's an average one. That's what. If it closes like this, I don't know if it's going to close low enough because we're going to be gone in about 1 minute. Yeah, I like these, but they need to. The candle should penetrate the edge of the box, really. Dom, you can download data from. What you can do, Dom, is you can download data from a broker that has a 5 p.m. close instead of using the default data for Forex Tester. That's one way to get around it. See, look at what's happening right now, guys. See how this is now not turning into a kangaroo tail anymore? And there it is. It's not a kangaroo tail. Last 5 minutes it did something freaky. The 1 hour charts always do. Thanks, guys, for your time. I really appreciate it. I hope you have a wonderful trading week. Take it easy, Dom. See you, Powell. Thank you, FX Street. See you, Aristides. Bye, Mish. See you, Sylvester. And take care, everyone. Thanks for Sika. Bye. Bye, guys.